What's going on, everybody? I am Sami Abusad, Director of Education at T3 Live. Welcome to this week's video. We are in the middle of a coaching session for Strategic Day Trader Room members, and I like to share with you today's lesson. So for today, we're going to just pick up where we left off last week and talk about how to avoid breakout failures. Last week we talked about how to play breakouts. We talked about the two types of breakouts that are available to us as day and swing traders. And I'm going to give you a recap of last week's lesson and then take it a step further and show you how to avoid the ones that fail, because the breakout pattern is by far the most commonly recognized pattern in the world. Why? Because it's so easy. Even a caveman can do it. You have a stock that's going sideways. All of a sudden, it breaks out over resistance, over a base. So every single person in the world that's watching this stock, that's looking to play it, knows exactly what to do. They get in right here. As soon as it breaks out, they get in, and then they say, "Okay, let's watch it make me money." They don't buy it after that. They buy it here. But in order for the stock to continue higher, in order for it to move up, somebody else has to buy it. And then somebody else has to buy it still. More people have to buy it to make it continue to go higher. But if everybody gets it here, then you get that initial pop. And then as people look to sell, the ones that are looking to just make a quick buck and move on something else, it fails. So breakouts, unfortunately, because the breakout pattern, because it's the most easily recognizable pattern in the world, it's also the most susceptible to failure. So today we're going to talk about how to avoid breakout failures. But before I start, I just want to say I need to share with you this standard required disclaimer to let you know that trading is risky and that whatever we discuss today is for educational purposes only. Also, I want to invite you to check out the links in the description of this video, some helpful links. And with that said, let's dig in. Last week, we talked about the two types. I don't want to read the whole thing because it would make a really long lesson today. So I just want to say last week we talked about two types of breakouts. The first one is the result of a transition A, which is when stocks go through a 4-stage cycle, and when the stock is going from stage 1 to stage 2, transitioning. In fact, before I got on the mic here I started broadcasting this, we were talking about, let me show you. We're talking about some of the transition gaps that I like to play, swing, like these, stocks that are, as you can see, this was transitioning, and this was a gap that created the transition, right? Transitioning. What do I mean by transitioning? Going from stage 1, the sideways base, to stage 2. But sometimes it doesn't really base, or it doesn't base and break out, it just gaps. So we were discussing, before I started broadcasting, we were discussing how to play these. See this? Gapped over a 3-month base and then broke out. Right? So those are, look at this, transition A. Came from stage 4, then stage 1, and then a breakout. So we're discussing how to play these when it comes to swing trading, right? But for today, we're going to talk about that sort of gap, not through that sort of base breakout, not through a gap like here, but when it actually breaks out, right? And we said that's the first type of gap that we play, is when it's a transition A breakout. Whether swing or day trading, doesn't really matter. Swing or day trading, doesn't matter. The entry for this would be over the base, stop under it. If we're looking to play it swing, I like to also put my stop under the 20, especially if the 20 is being respected, it's not being negated. So that's the transition A gap, okay? But then, and of course, this transition C is the same. Transition C gap is the same. This is the breakdown. But then we said sometimes stock is already in an uptrend, is not actually transitioning, is not making a U-turn, is already in an uptrend, and then bases. And the question here is, how do we know whether this is a base breakout that's going to continue higher, or a top, a base that's going to reverse the trend and continue lower? And this second type of breakout is called the pause that refreshes. It refreshes the trend. It gives it a breather, right? So moves up, bases, and then pops. We said there are more than 3, 4, 5 different characteristics to the pause that refreshes versus the reversal base, versus the one that result in a stage 4 downtrend. We said pauses are narrow. From left to right, they're usually not very wide bases. They're narrow. Pauses have small bars. So from top to bottom, the base is not very wide or not very thick, so to speak. It's really thin. Because why? Because they have small bars. Of course, in this case, we did have a decent sized bar there, but that was a shakeout, a breakdown failure bar, which confirms that this stock was going to go up, not down. Because if it was down, if it was going to continue lower, it would have actually followed through onto that red bar. And pauses have light volume. Reversals or stage 3s have big volume usually. Number 4, they break out at or near the point of contact with the 20. Usually they're not far away from it. Stage 3s have a flat 20, or they're very far above it, extended. And you can add another point here. I mean, I can add it right here. Pauses, I can't add it, whatever. But what I wanted to say was, pauses versus reversals. Pauses come from a nice, well-established, controlled uptrend. They don't come from a climactic trend. They don't come from an erratic or like a sloppy uptrend or a climactic uptrend. When they do that, they go vertical and they go sideways. Oh, be very careful. I wouldn't play it long because it usually fails. So that's how you can tell. There are other points here, but if you want to get all the points and more information, go back to last week's video. But those are pauses. Tight base, small bars, low volume at the point of contact with the 20, breakout. The trend that preceded the base was just a beautiful uptrend, bullish uptrend that wasn't extended or accelerated. This is also called the pinch play, when a stock has a flat 20 and a flat 200 period moving average and a rising 20, and the stock oscillates between the two, eventually putting in equal highs and higher lows. Equal highs, higher lows. Eventually the stock the 20 kind of pinches the stock from underneath the 200 and causes the breakout. So that's called the pinch play. Beautiful. I said last week that my favorite type of a breakout is the one that goes to the high of the day and bases at the high of the day. Because when a stock goes to the high of the day, it's supposed to pull back off of it. It's supposed to give you a double top. That's why people short double tops. But if a stock goes to the prior pivot high and bases at the prior pivot high, that means the stock is too strong to pull back. It's really, really strong. After the 20 MA, breakout, play it long. That's my favorite type of a breakout. Okay? So long over the base. In this case, it has a shakeout bar. Amazing. Just picture perfect, totally. And this is another continuation type base, but this is actually called the late day breakout, when the 20 MA catches up to the stock and the stock does not break out, and instead it continues to go sideways and the 20 MA goes flat. This is the rising 20 period moving average, goes flat. At some point, that 20 MA will halt the price from continuing lower and it will start to put in higher lows. And when the 20 MA halts the stock, it doesn't dip below it, then you know it's about ready to break out. Does that make sense? Meaning here, when it went flat, price went below it. Price went below it. Price went below it. It wasn't ready yet. Price, did it go below it? It did not. That's how you know it's ready to break out. And usually happens at 2:15 to 2:30 in the afternoon. So take a look, almost 2:30. in the afternoon. Had the breakout and then plus a 1, 2, 3, 4 entry, and then the pullback here. Absolutely beautiful. And look at the move up. So this is just phenomenal. This was phenomenal because it had the railroad tracks, right, between the 8 and the 20, or the 20 and the 40, whatever you use is fine. This was at the high of the day also, and you can see the pattern was tightening up, right? First oscillating pretty widely, and then look at this, very tight. When it gets really tight like this, then you know it's about ready to break out. So those are all examples of the pause. Of course, examples to the downside here. The breakdown in a stage 4 downtrend, right? In a stage 4 downtrend, breakdown. In a stage 4 downtrend, breakdown. And then we talked about how when the trend gets a little bit ahead of itself, gets a little climactic, then away from the 20, away from the 200, and the base is pretty sloppy, and volume actually picks up towards the end of the base, that's the kind of a reversal, not a continuation base. This is the kind of play that you'd expect it to go back up rather than actually continue the base. And the same here, the 20 goes flat far away from the 200. This is the type of a play that you want to play long against the breakdown, the trend. Does that make sense? So we talked about that last week. In this week's lesson, I want to talk about how to avoid breakout failures or failed breakouts. Okay? Failed breakouts. Let me edit the title right here. I call this the breakout with no follow-through rule. So BONFT, breakout with no follow-through. Most failed breakouts happen in exactly the same way. The stock puts in a wide range bar followed by one or more inside or narrow range bars. The stock then breaks under the low of the inside bar or bars and begins to break down. This is what I call the breakout with no follow-through, and it is how 90% of all breakouts fail. How 90% of all breakouts, my apologies, I didn't proofread, I guess. How 90% of all breakouts fail. It's also how most trends end. So let me show you. This is the picture. It's the picture of a breakout, and then the stock breaks out, nice volume. Most people, why does it get the volume? Because most people get in here. I mean, professional traders, novice traders, institutional traders, every type of trader in the world knows to get it right here. The issue is, in order to consider anything of significance, in order to consider a bar significant, it needs to have follow-through. Know that one bar events, no matter how significant they are, if they don't produce follow-through, if the stock actually reverses or puts in, just puts in a red bar or a doji bar and then breaks under the doji bar's low, those are the ones that lead to big time failures. So again, bullish wide range igniting bars are nothing without follow-through. I know they are the footprints of money. I know it takes a lot of money to produce these kind of bars, but believe me when I say it doesn't matter. They are not any more powerful than the average bar if they don't produce follow-through. In fact, when they don't produce follow-through, it goes to show you how weak the stock is. So this is how most breakouts fail. The stock breaks out. After the breakout bar, you get a narrow range bar. If the stock takes out the narrow range bars high, continues higher, no harm, no foul. Perfect. You get basically a continuation 1, 2, 3 play. No problem at all. But if the narrow range bar's low gets taken out, you wanna get out of it right here. Okay? If sometimes I get out of it right here and the stock actually get out of it and eventually goes back up, and I say, darn, I got shaken out of this play. That's fine, because I didn't say that's how 100% of all breakouts fail. I said that's how 90% of all breakouts fail, right? So at least if I raise my stop, I'm avoiding 90% of all breakout failures. And sometimes I get shaken out, no problem. Let me show you some real examples. So first, now you know how to eliminate most breakout or breakdown failures. Spot the end of the move, because that's how most trends also end, and trail your position if you're in it long, or you can even initiate a new short, like a counter trend play. Let me show you some examples. If you were in the stock short, where would the correct exit be? If you were in it short, or if you played this breakdown, you should know by now, right here, out. Does that make sense? Okay, let's take a look. Next one. If you were in the stock long, or if you played this beautiful breakout, this is GOV, the symbol. Beautiful breakout. Wide range bar. Look at the volume. Everybody thought this was higher, myself included. What did it produce? A narrow range bar. And then the third bar broke under the narrow range bar's low. So out right here. Okay? Does that make sense? And then from there, as you can see, the stock eventually broke. Now, I just showed you a couple examples. I want you to know that sometimes I'm not saying that if this pattern sets up, if you get the wide range bar, narrow range bar, and the narrow range bar's low gets taken out, I'm not saying that the stock will always tank. Sometimes it'll drop a little bit and eventually go back up. But it almost always, not 100%, but about 90%, this is how high of a percentage it is, it will break under the base first before continuing higher, which means it will stop you out. Might as well raise your stop to under that doji bar's low and get out of it. Does that make sense? The breakout with no follow through, BONFT rule, is not a strategy. You can't apply it in a vacuum, meaning you really need to be looking at multiple time frames and know what you're doing. You can't just look at charts looking for this setup and play it in a vacuum regardless of what the other time frames look like, regardless of what the daily chart looks like, regardless of what kind of market environment we have. No, you really need to play it. You can't play it in a vacuum. You can't play anything in a vacuum. You have to know what you're doing. That's why scanners don't really work that well, right? And automated trading, because they can't analyze all of these other variables. There's too many variables, right? You'd have to spend a fortune to set up a scanner that looks at all these other variables, and it still doesn't have the brains to think like you and I do. So that's why automated trading, that's why patterns still work. If automated trading worked all the time, then every scanner in the world would be programmed to go long right here or to go short right here, and they would all make money. But that's not the case, right? The BONFT rule applies to daily charts and swing trading in exactly the same way as it does to intraday charts. However, if you don't heed the message, if you don't listen to the message of the market, the consequences when it comes to swing trading can be devastating, because we have overnight gaps. That's why. These are all things that I played myself. That's how I have the charts. I didn't go around collecting these charts. These are things that I played myself. Day traded, swing traded, right? In this case, this is the daily chart. And as you can see, breakout, beautiful. Okay, great. Let's make some money. Breaks out, and I see this dreadful narrow range bar out right here. I didn't want to be out right here. My target, I don't remember what my target was. Probably was up here somewhere. But you have to listen to the message of the market and not impose our own. And not, it's not about wishful thinking. So out right here. If not, where would you get out? If you didn't get out on the third day, then a huge gap, a 10% gap or more than a 10% gap down the next day, right? Breakout, nice, let's play it. Narrow range bar, out right here on the third day, small loss. If not, see what happened the day after that? This was, so beautiful. It rallied like $2, I think, 15%. Everybody was saying, Sammy, what a great trade. I kid you not. As I got so many messages and comments in the room about how good of a trade this was, swing trade that I called. Okay, and then look what happened after that. Unfortunately, do I know why? To this day, do I know why this chart failed? I don't know why. It looked perfect. Everything about it looked perfect. Look at the volume. when it based. When it popped, it always had big volume, beautiful, on the green bars. When it based or pulled back, low volume, beautiful. Look on the breakout that I played, the kind of volume that we got. Gorgeous. I thought the 200 MA was my target. This is a 200 period moving average. The next day, after the breakout, I got that dreadful narrow range inside bar. Third day, I'm out. And if I didn't get out, I'm glad I did. If I didn't get out, that's where I would have gotten out. It would have stopped me out, basically. On that gap down, from there, it never looked back. It never actually recovered. Does that make sense? Same here. Okay, now I just want to show you this. This was not a play that I took long. This was a stock that was going climactic on the weekly chart. Okay? It was going climactic on the weekly. I tried to short it. Apparently, I didn't do such a good job because I took 2 stops on it. Tried to short it on the daily chart. Didn't work. I don't know where I shorted it here. Here, maybe, didn't work. And look how it ended up working, but I didn't even do it. Broke out, in this case, into resistance, really. Narrow range bar from $70. That's $70. Look at this. A few days later, a couple weeks later, $45. And continued lower. So this was actually something that I wanted to play short, and it only gave you, the entry that worked was on a breakout with no follow through, right? This is NUS. I mean, how can you not love this? Look at the breakout. Gorgeous. Cleared all of this resistance. In it, to win it, to 100 target. After I'm in it that day. And then 2 narrow range bars. I'm out on a gap down because it didn't trail me out. But I'm glad I took it, because the day after it was a 20% gap down. Does that make sense? So when you're swing trading, if you don't know what you're doing, your problems can become real serious problems. Your losses can become a lot bigger because we have overnight gaps. Okay? So that's the play. Now let's take this a step further and use the breakout with no follow through that I shared with you, that we discussed so far, as an entry. So if you're looking at something that's down a lot, climactic, you can actually play it long. I teach strategic swing traders that there are 4 different ways in which stocks go climactic. The first one is when you go just a vertical drop, the waterfall is what I call. And then there are 3 other ones. One of the 4 is the climactic, that goes sideways a little bit at the bottom, breaks down, and the breakdown has no follow through. It has a narrow range bar. You play it long above the narrow range bar's high. So long right here, stop right here. Or if you're in it short, then you know to trail and flip long. You can. Does that make sense? So that's how this stock was played. 20-cent stop. It was 106.20 the entry. Stop was 106. I still remember the play to this day. Okay. Now, what's the name of this pattern? This is a buy setup pattern. Look how it's set up. This is Expedia. Gapped up, pulled back, down, 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 and then the wide range bar, that's the breakdown that ends the trend. That's how most breakdowns, how most trends end, how most pullbacks end. Why do you think this ended the downtrend? The pullback, and then narrow range bar, long. Bam, this was a professional gap up this day. Can you name the pattern? Yes, we can. This is called the buy setup pattern. Why do you think most pullbacks also, when they pull back, when the stock pulls back, it ends, if it's a deep pullback too, it ends through a kind of a breakdown with no follow through? You know why? Because the stock can't go back up until the sellers are out, the weak hands. How do they get shaken out? They get shaken out when they finally get that breakdown bar. And notice it was right into the rising 20. So for the professional trader, this was an opportunity to play something long as the stock exhausted itself. Does that make sense? Shook out the weak hands. So, all right, when people want out, I just say, okay, let me take that off your hands. As a professional trader, because I recognize what's happening and I look to take advantage. Now let's see if you really understood this concept of the breakout with no follow-through. If you did, then you should be able to answer the question of which one was a valid BONFT. First one or second one? Feel free to participate on social media, in the room here, in the VTF. Feel free to participate. Anybody? I'll give you a minute. This was a novice gap up this day, and that ran up, went climactic, but I missed the top. I missed the top. I missed the top. I thought I missed it. It gave me another way in, which was through the breakout with no follow through. Okay, I'm looking at the answers. The second one, not the first. Right. Exactly, because the breakout with no follow through concept that I'm teaching you, it has to always come after a base. Do we see a base here preceding that big green bar, narrow range bar? No. Do we have a base here? Yes, we did. Breakout, narrow range bar. So short right here. Stop right here. Okay? So the breakout with no follow through, it always has to come after a base. Some kind of a base. Did this have a base? Oh yeah, it did. That's a base. Did this have a base? Yes, short base, but it's a base. Did this have a base? Yes, it did. This didn't really have much of a base, but here it is. 1, 2, 3, 4, 5, but it was just a sloppy base. Did this have a base? Oh yeah, every single one had a base. Okay? So the breakout with no follow-through concept always works if it's not always works, but it only is valid when it's preceded by a base. If it doesn't have a base, then you don't want to do it. Did this have a base? Yes, a 2-bar base. Very narrow base, but at least it's slowing in the momentum, basically. High momentum, and then a slowing in the momentum, and then the breakout, and then no follow-through. This was a climactic run-up, basically. Short, out, continued lower, but that was my exit. So, any questions on this? I hope this was helpful. So we talked again, we did a recap. We said there are really 3, but 2 types of breakouts that we want to play. The transition A or the pause that refreshes. Transition A breakout, transition C breakdown, or the pause that's already part of an uptrend or a downtrend. Okay, and then we said, wait a second, but we know the breakout pattern is the most commonly recognized pattern in the world, and people get in as soon as the stock breaks out, and then they sit on hands thinking, well, let's see it make money for us. But then they don't buy it. If that happens, it usually fails shortly after popping, because there's no demand. There's only demand at the point of when it first breaks out, and then that's it. If that happens, then how do we eliminate the ones that fail? Because you can't really predict. I mean, could I have predicted this was going to fail? No. So you eliminate it by by seeing if it produces follow-through or lacks follow-through. If it produces follow-through, then you just keep your stop here, and then after 2 green bars in your favor, you can start managing bar by bar. Okay? If it doesn't produce follow-through, then you have to raise your stop. As much as for example, in this case, as much as I hated getting out of it, I didn't want to get out of it. I thought it was picture perfect. If I didn't get out of it here, I would have actually lost $3 or something like this. Does that make sense? So I hope that was helpful. This is the kind of education that you get exposed to being a part of the Strategic Day Trader Room. Check us out if you've never been a member. You can try the room for 30 days for only $49. As you can see, this is education that's not available anywhere else. Trust me when I say this, it's not available anywhere else. Check out other people's content and videos and see if they offer you something like this, or all just talking and mumbo jumbo stuff that's not practical, that doesn't give you things that you can actually put to work starting tomorrow. Does that make sense? So this is what I'm all about. I'm an accountant by trade. I'm very practical, step by step kind of guy. So check us out if you've never been a part of the room. 30 days for just $49. 30 days for just $49. Link is in the description. And I also provided other links. For example, I'm going to be teaching an in-person mentorship. You can trade with me for a whole week in New York City in October. So I dropped the link also in the description of the video for that, and other links as well. So feel free to check those out. And if you liked the video, found benefit in it, then I accomplished my objective. And if you did, please be sure to hit the like button. Thanks so much, guys. Have a wonderful evening, and I'll talk to you next week. Take care, everybody. Good night.